Good morning, everyone. Welcome to this first edition of the Global Stocks and Commodity Update for the 12th of January. 2020, what's ahead? Is it going to be a repeat of 2019 in some respects in terms of what stocks do? Or is it likely to be something different? So that's what I want to take a bit of a look at. This is not going to be a forecast because such things are a waste of time, but just really where the weight of evidence is pointing at this point in time. We've certainly had quite a lot of things happening in the last couple of weeks since the last one of these that I did just before Christmas. We've seen certainly the trade war situation reach some point of resolution. We've seen obviously some real tensions arise in the Middle East. And so there's been plenty to keep markets on its toes, but net around the world, markets have gone higher. So it's been a very positive period. So I just want to try and look at, where is the weight of evidence for 2020 and how we should go about finding the strongest returns that we can. And that's really the theme that underpins all of these videos every week is really just that. How do you go about getting a good return and minimising the downsides as they come along. There'll be the normal stock and commodity trend updates, and Portfolio Analyst started last week, and it was a huge addition. And there were specific questions around portfolio management, around some dilemmas that I've got around investing in China, some extremely compelling, but some issues on the other side as well. And there was also a new stock added to the 10-bagger portfolio, which is just bubbling along really, really well. So let's get into it. Bit of a quick review. The things that worried markets in 2019, obviously the trade war was probably the number one. Then it was secondary to that, but also important, was the prospect of global growth and the possibility of a recession. And whilst recessions weren't really discussed that much for the US and China, other than by people who seem to be habitually bearish, certainly what is going on in the world's two largest economies by a very large margin is obviously important for everybody. So that was very much on everybody's mind in 2019. We entered 2019 with inflation as a target for central banks, and they started raising interest rates in the latter part of 2018. Markets hated that, and so they were forced to abruptly stop. Inflation certainly didn't appear in any respect. And then, of course, we finished off the year with a flare up in the Middle East. So if we look at those things that worried the market in 2019, the trade war, a phase one deal, would now appear to be a done deal. And that's nice progress, but it's not actually going to move the dial that much in terms of capital investment spending for businesses. That's going to require something with a lot more substance to it. But nevertheless, it was a good step in the right direction. Global growth seems to now have stabilised, and we can probably look forward to some acceleration. That's where the signs are, is that we're going to see some mild acceleration of global growth, and even in Europe are the current signs. And of course, there's no prospect that central banks are going to get back to raising interest rates anytime soon. So what about 2020? Is really, I think, the issues that are going to concern markets this year, because markets have always got to have something to worry about. So I think these will be the things that will prevail. It'll just be the fact that the economic cycle is as longer than it ever normally gets to, and therefore can it be sustained? Secondly, a phase two trade deal, which will involve far more meaningful things like intellectual property, technology, and capital investment. That is going to be far more difficult because there are just huge ideological differences between America and China. America is number one dog on the block, and China wants to be number one. So I think that's pretty much an unreconcilable position. So I don't have high hopes that a phase two trade deal is going to get done. And the implication for that, of course, is that that will hold capital investment back, and that will have an impact on global growth. The direction of currencies are critically important, and Trump has been on record for the last 18 months saying that he wants a lower US dollar. Hasn't really been able to to get it, but I think he's going to continue to keep the pressure on the Fed to try and get the US dollar down. And where the US dollar goes has massive implications for money flows around the world, and therefore for economic growth. So, you know, you can't divorce those two issues. The US and global reality is that attempts to normalise interest rates and to normalise central bank balance sheets failed dismally in the final quarter of 2018. Markets just fell over, and economies started to to head in the wrong direction. So that was a dismal failure, and so we're not going to go back to that position anytime soon. So this is the new economic reality, that central banks are stuck. Now, I don't know how that's going to play out. There may not be any meaningful change in economic growth for years to come. Who knows? But certainly central banks are stuck, and we are going to have a low interest rate regime for as far as the eye can see. That would appear to be the case. And if you look at US government debt servicing costs in 2019, it was $440 billion, and that was at an interest rate of around about 2%. So the US was trying to get interest rates up to 4%. They only got to 3.25%, and markets fell over. So, the reality is that if interest rates did go to 3%, then that debt service cost goes up by 50%. And you just end up with a continuation of this massive debt spiral. The US overall debt is around $23 trillion, and they're adding to it at $500 billion a year just on the debt servicing without actually any further borrowings. So that was why the market freaked in late 2018. Central banks were first to do an about face, and that is why we ended up with a very positive 2019. I doubt very much that that can be sustained into 2020. It's just unrealistic to expect that would be the case. But we'll just have to wait and see and remain open-minded. So the only way out, to my way of thinking, for governments and central banks is they've got to inflate away the debt. They can't raise interest rates to try and attack the problem that way because markets just aren't going to allow it. So they've got to try and inflate away the debt. And this is what Japan has been effectively trying to do for more than a decade, trying to get inflation up to 2%. So we've now got the Bank of Japan, we've got the ECB, we've got the Fed, all with inflation targets. So they're not so worried that much about economic growth. It's more about getting an inflation target. And ultimately, who pays for that? Well, the consumer pays for it. At the end of the day, retirees pay for it, who were hoping to get a risk-free return on their money from government bonds. They're the ones that are ultimately paying for that. And this is really, I think, what is underpinning the move in gold that we saw in 2019 is at a big picture level. The smart money is looking at this and saying, well, if this is the only way out for central banks is to inflate away the debt, then we have to own gold. There's really no alternative. Now, having said that, they've been spectacularly unsuccessful at getting inflation up. So, there's no guarantee that inflation will break out. But gold is moving on the assumption that central banks ultimately will be successful. The Australian and US indices, I think it's unrealistic to expect another surge in 2020 as we saw last year. But the case for really significant outperformance by Australian small caps, particularly the technology disruptors remains very much intact. And this is what's underpinned a lot of the success in the market in 2019. So this is just a quick look at where the indicators are pointing. This is not a forecast. Please don't confuse it with a forecast. It is just looking at the weight of evidence, both technical and fundamental, and assigning some probabilities around where those things are pointing. Gold is heading higher, and certainly the change in direction of central banks at the end of 2018 would support gold heading higher. Secondly, stock indices probably far more likely to have mild gains at the index level, but with higher volatility, and particularly if things keep bubbling along in the Middle East as they have recently. US dollar probably lower. Looks like it's stalled and rolling over, and Trump wants it lower and has been on the record that he wants it lower. So he's going to keep the pressure on the Fed to do that, and certainly a lower US dollar is good for the US economy. So they've got a vested interest in that. Interest rates probably little changed. Central banks would appear to have no capacity to raise interest rates, and they may not need to lower interest rates, particularly if global growth is starting to pick up a little bit. But very important, whilst these are where the indicators are pointing, you've just got to keep an open mind and be prepared to change tack if warranted. Don't lock yourself into a position on any of these things. Just observe and respond is the way to deal with markets these days. Turning to American stocks, the S&P finished at 3265, very, very buoyant, and that's quite a bit higher than where we finished in the last video that I did in the middle of December. What I am seeing, however, of late is just an acceleration of euphoric buying, certainly in stocks like Apple, Google, Microsoft, Facebook, etc. And I'll show you some charts on those in just a minute. There's been a real acceleration there. So in the short term, that just makes me a little bit cautious because they really have extended to quite a large extent in the very short term. We can't know what future economic growth is going to do because we don't know what central banks are going to do. We still know that they've still got quite a bit of clout, and they're going to exercise that. So it's pretty futile trying to forecast where economic growth is going to be. I think it's much more sensible just to observe what the market is doing and just apply some good sensible risk management rules around that. Trade what is, and forget about forecasting and trying to be a hero, because it's really just a waste of time. The US dollar finished at 97.36. It's been pretty volatile of late, and it's a really instructive chart to look at. And the direction of the US dollar, as I said before, is vital for not only economies but also for stocks, because it really dictates where money flows are going around the world. So the US dollar, it's in a medium to longer term uptrend, but that uptrend seems to be stalling, and it has dropped out of the trend channel. That's the reality. Also, I do note that quant funds are positioned strongly for a lower US dollar, and quant funds do have quite an impact on markets these days. The other point that I'd also make is that global currency volatility, so how much the currencies are moving around, has dropped to a very low level, and that's not sustainable in anything, whether it's currency or stocks or whatever it might be. Periods of extremely low volatility are not sustainable, and you do get some mean reversion. We just don't know when that's going to be, but just note that it's likely we're going to get some sort of currency breakout at some point in time. And the 10-year yield for the US government bond is 1.82%, which is pretty much the same as it was a month ago. So let's take a look at, first of all, the S&P. So there's the monthly chart. This is 2009, so this is very big picture stuff, but you can see after we got that correction in the final quarter of 2018, it was quite an acceleration, which is still ongoing. Zeroing in on the daily chart, you can see we got a little bit of a pullback on Friday, a little bit of easing. The market is quite overbought from a technical point of view in the short term. We're well above the 50-day moving average, so some sort of consolidation. This we got a breakout here in at the end of October, and it's gone almost straight up. We had 2 days down here in December, and that was it. It's gone straight up, so you've got to expect some sort of consolidation. US earnings season starts next week, so that could provide the catalyst for some volatility in the market. If we just take a quick look at Apple, so there's Apple. This is on a weekly chart, so you can see the incredible acceleration there's been in the price of Apple just in the last, since October, so in the last quarter. There's Google, not quite as much as Apple, but certainly an acceleration quite sharply in the last week. There's Microsoft, and it's very similar to Apple. It's gone up a huge amount from $100 at the start of 2019, and now we're at $160. Now, both of those stocks, all of those stocks really are, I think, very much at the upper end of their valuations. And I just think that's all become a little bit overdone in the short term. So just a little bit of short-term caution because some stocks have moved quite massively. Now, turning to the US dollar, so this is really important. So here's a big picture of the US dollar. These peaks back here were in February of 2002. So this is quite big picture. This is nearly 20 years. We fell down to 71 in just before just before the GFC in 2018, and then since then we've been in a very broad uptrending channel since, well, basically after the GFC. The US dollar has been sort of progressively heading higher. Now you can see of late, since August of 2018, there's been a smaller uptrending channel, but nevertheless uptrending. And if you look at that, we seem to have stalled. We've dropped below these lows here. And I'm just spending a little bit of time on the US dollar because it is so critical for the valuation of all other asset classes. So we managed to take out these lows. We then got back into an uptrending channel, but we've been unable to set new highs. So this, on a big picture level, certainly does seem to be stalling and rolling over. And if we zero in, you'll see that the US dollar has in fact breached that uptrending channel. We've rallied back to it, but I think the indicators now, particularly when you look at the positioning of the quant funds in the futures market, they've moved very sharply to the downside, and there is quite a good correlation between the positioning of quant funds and the direction of the US dollar. There's a lag, so the quant funds change their position sometimes weeks or even months before the US dollar changes direction, but ultimately there is quite a good correlation. So at the moment, all the indicators are pointing to a lower US dollar. And of course, a lower US dollar is going to be good for gold. All right, so that's the US market. Turning to the Aussie market, our dollar, it was generally higher because of the weakness in the US dollar of late. And our index, our ASX 200 index, broke out to new all-time highs. So we finished it's above 6,900 points, which is basically a new all-time high since 2007. The index ended up gaining 3% on the week, so quite a strong surge. I've been quite wrong on the index. Not that bothers me in the slightest, because I don't pay any real attention to the index in terms of my own trading and investing. It's a meaningless number to me, but I just didn't see the Australian index being able to break out, mainly because of the headwinds for the banks. But look, it has. It doesn't have any real consequence for me. I think it's far more important that we look at what we're invested in at an overall stock level. I think it's probably more likely we're going to get mild gains, if that, for 2020, but I may be proven wrong again on that one. However, I think where I do feel much more comfortable about being on the right side of the ledger is that most of the top 100 stocks are going to struggle for reasons that I'll get to in a minute. And so it's outside of the top 100 or outside of the top 200 where the big progress can be made. And also, in my view, I think they can be made with a great deal more certainty if one selects well. So I think this is very much about a stock picker's market. There are many low growth companies in the top 100 that have had their PE multiples expanded considerably. So their earnings are not growing. The prices have gone up, not because earnings are growing to any great extent, but because the market has been prepared to award a higher PE, or people have been chasing yields, which have forced yields down and PE multiples up. So to me, this is where the biggest danger lies. It's in these so-called value stocks that are showing very low growth. So as I've been saying consistently now for some time, I believe the greatest protection in the market is not to go for the perceived safe havens, the perceived low volatility stocks, because if they're also low growth stocks and high debt stocks, then that's where the greatest risk is. So I think growth is what will protect you. And so if you buy really good, solid, high quality growth stocks, then I think that's the best positioning that one can do. All right, let's just take a quick peek at the ASX 200. So it's a very nice breakout, as you can see, very solid last week. We've been building up underneath that resistance around the 68.60 mark for some time in a triangle. We eventually broke out on Friday, and that is new all-time highs. So there was the peak back there in 2007. So we've managed to finally break out above that. But again, just for the record, I just think that the banks are going to struggle, and I think that's going to put a bit of a handbrake on the ASX 200. If you look at the Australian dollar, so you can see we had a breakout, very strong breakout with the plunge in the US dollar, but now the US dollar has rebounded. We're back down again on the Australian dollar. Now, turning to gold. So obviously there's been a very big move here in gold. This is the weekly chart. So let's just get a bit of a big picture view here. So this was the peak in 2011. We then had a massive slide until we hit the lows in 2015, and putting a Fibonacci retracement on that whole move, that whole 4-year move, gave us potential rebounds, 38.2 right there, which is where the market went to at 1377 before it pulled back. We then had the next level at 50%, which was around 1480. We went straight through that and overran it before pulling back. And then we've got this ultimate level up here, which has just been breached on basically an intraday level. That's the 61.8%. So it's quite amazing how the gold price, in terms of its technical fundamentals, has been responding to this very big picture that's been unfolding for some time. So you can see this is the final quarter of 2018. So this is where central banks were tightening policy and then had to abruptly change course and start easing again. And you can see that's when gold has basically taken off from around about the 1250 mark. And intraday, we hit $1,612 last week. So that's the big picture. Now, once we can get above this sort of 1600 level and sustain it, then there's really no resistance until we get to 1800. So there's a big window here for gold to surge a couple of $100. And I think that the potential driver here will be the US dollar. If you look at 2018, 2019, it was the reduction in interest rates that did a lot of the work for the gold price to go higher. Because interest rates are now so low, it's hard to see that that's going to be a factor in driving gold higher. So, that work's already been done. So I think that the most logical driver for gold is going to be the direction of the US dollar. And as we saw, certainly Trump wants it lower. The quantitative funds have positioned themselves for a lower US dollar. So I think it's logical to assume that we're going to see a continuation of what is. And what is quite a steep uptrend. You can see that quite steep channel there. So gold finished at 1562. So it really got fired up on the situation in the Middle East, with missiles being fired around the place. But if we go into a daily, so you can see that. So the market got really excited, as it often did when some missiles took off. But as soon as that calmed down, then we saw that premium, that geopolitical premium, come out of gold very, very, very quickly. So let's take a quick look at precious metals. So gold has done a temporary breakout, but wasn't sustained at this point in time. Now, as you know, I've been talking about this overhang in the futures market now for months, and that still applies. That's still there. It hasn't unwound, and that is the potential danger. But it would appear that it's being overridden by the positioning of quantitative funds, not only in the US dollar, but also in gold itself. So that's one factor that is perhaps overriding what's happening, or what would normally happen in the futures market. And secondly, we also know that central banks have been buying significantly since 2019. And in fact, there was 153 tonnes of gold bought by central banks just in Q3 last year alone. That is massive buying. So it would appear that that is a new level of buying, which is offsetting the normal situation which would occur in the futures market. So that makes a bit more sense to me, because I've been, quite confused by the lack of unwind in the futures market. But that would certainly provide a reasonably plausible explanation for that. So the underlying trend, or uptrend in gold, started with what was a very abrupt reversal in central bank policy. It was the Fed, it was the People's Bank of China, it was the ECB, and it was the Bank of Japan. They all basically reversed course, and it's pretty hard to see them changing that course now, because the consequences were pretty drastic, not only in economies but also in stocks. And the reality is that low to negative real interest rates, so it's nominal rates minus the rate of inflation, is good for gold, because if you're not getting a return in real terms from interest rates from bonds, then there's no penalty for being in gold, because gold doesn't pay a dividend or an interest rate. So there's no penalty, and so therefore that's more of a positive for gold. So I think that work has already been done, and that started the uptrend. I think the uptrend can be sustained by a lower US dollar. Now, gold gained 18% in 2019, and GDX gained 42%, which is normal. The leverage factor is generally somewhere between 2.5 and 4 times. So that's about 2.5 times. So that's about right. And if gold continues higher, then we should see gold stocks amplify that as well. GDX is a big picture uptrend, and we should play it accordingly. And I think that's nothing much more needs to be said on that, other than let's take a quick look at GDX. So this is GDX on a weekly. So you can see we pretty much mirrored the fall in gold, but obviously that fall was much greater. We fell from 66 down to 12. So it amplifies in both directions. We had a steep rise in 2016. We've then got into a long consolidation. We managed to break out above these highs here at around 25.50. That occurred in the middle of last year. We came up, almost got to the 2016 highs, pulled back, which is a normal retracement, and now we seem to be moving higher again. So everything is tying up pretty nicely with GDX. If we can break above this level here at 31.50, then I think we're probably looking at a move back up to the 50% retracement, which also corresponds with the 2012 lows. And because those lows were tested as well, that creates a lot of validity around this 39.50 mark. So a break above 31.50 on GDX probably sees us targeting 39.50 on GDX. So a pretty nice trade there for anyone that does trade in gold and GDX. All right, turning to other commodities. Copper, not much change in the last month, $2.79. Crude oil has been extremely volatile around what's been happening in the Middle East. Closed at 59, so we had a big spike into the 60s and then a big pullback as tensions eased in commodities. There's the copper price chart, not much change there. Inventories have continued to be drawn down over the last 3 weeks since I last did one of these. So we're now approaching 5-year lows in inventories. And if we do get the US dollar heading lower, then that's obviously going to be very positive for copper and other base metals, because not only will we have low inventory levels, but we'll also have the currency tending to push the price higher. So we could actually see some, if you think about it, we could see some good moves in BHP and Rio, particularly from the copper side of things. This is spot nickel. So we had a huge surge due to Indonesia's bringing forward of their export ban. That obviously got ahead of itself. Some of that excess has come out of it, and then we're getting a bit of a stabilisation in the nickel price. So just to wrap it up, some final thoughts. Don't trade markets, trade individual stocks. Find the best stocks you can find, trade them on their merits, and I think you've got the capacity then to do quite well. I think if you try and trade indices or markets, I just don't think it's realistic to expect a repeat of what we saw last year, when indices actually did quite well. This is what I put down before Christmas. I just think it's just such a good reminder of how we should think about the markets and how we should act. You want to act when it feels uncomfortable in quality growth stocks, except that many traditional stocks are just not going to cut the mustard, particularly in the top 100 in Australia. You need to develop a watch list of high probability and high quality growth stocks. So not only high quality, but also they've got catalysts that are likely to move the price forward in the near term. You've got to be patient, because sometimes you might have to wait 6 or 12 months for a certain stock to get to a position that really makes good sense, and then have the conviction to pull the trigger after some selling, because generally when there's some selling gone on, the natural human inclination is to think, well, the price is going down, I wonder what's wrong. And if you're buying high quality stocks, it's often there's nothing going wrong at all. It's just the market has reassessed how they've been valuing the stock, and it's creating an opportunity. And of course, in the small cap space in Australia, there are stocks that are just below the radar, and there's hardly any analysts covering them. People don't understand them. They're not widely recognised, and that's where a lot of the opportunities are. US stocks are short-term overbought, as I showed you, so you've got to be realistic about the very, very short term. So I think that's really just how you go about fine-tuning your entries. We've got US earnings season starting next week, so that'll be really important for markets to see if the growth that's been priced in is fact going to come through. Portfolio Analyst upcoming, I'm going to be focusing on the investment methodology that I use, because I think it's important for members of my services that are, that are looking at recommendations and looking at the analysis. They need to feel comfortable that it's on a good basis. So I just want to cover that again in Portfolio Analyst. There's my contact details for anyone who's not a member of any of the 4 services that I run, and I'll look forward to being back with you next week, now that I'm sort of back in the saddle on a permanent basis. That's it for this week. Cheers.